I do understand that at a human level, but as a piece of economics, it's pretty poor because it's precisely that increase in price and the profit associated with it that you need to correct the imbalance between supply and demand that's caused the problem in the first place. Every single example of rent controls has backfired in one way or another, including the recent experiments in Scotland.
Britain's biggest retailer, Tesco, has come under fire in recent weeks for doubling its pre-tax profit in a single year to $2.3 billion. This has been labelled outrageous profiteering in a time when many families are struggling to put food on the table. Yet Tesco's profit margins remain relatively thin, and the grocery sector also hyper-competitive. Profit can also even be an important reward for hard work and incentive to invest and grow. Welcome back to the IEA podcast. My name is Matthew Lesh, and I'm the IEA's Director of Public Policy and Communications. Each week, this podcast asks a tantalising policy question. Today's question, is Tesco profiteering? To discuss, I'm very excited to be joined by the IEA's own Julian Jessop. He is our Economics Fellow, as well as an independent economist and member of the IEA's Shadow Policy Committee. Welcome back to the IEA podcast.
Thank you, Matt.
So let's get to the basics here. There was this kind of outrage about Tesco having a large profit in their recent earnings. What do you make of that? Why has it jumped up?
Well, I found the whole story deeply depressing, to be honest, in particular the way it was picked up by some accountants who I think really should know better, but we used this as an opportunity to bash Tesco's. For a start, if you look at the numbers themselves, the biggest reason for the recovery in the 2 years was that there were some one-off charges in the previous year that dropped out of the comparison. So it wasn't really comparing like with like. It is true that underlying profits still improve from one year to another, but that's not unusual when the economy is recovering. Tesco had done a really good job at improving the product range and keeping prices low and attracting more customers. So the increase in profit, such as it was, I think was, as you were suggesting, a reward for success. It's also important to step back, and as you said in the introduction, the supermarket sector is probably the most competitive sector in the British economy. So the idea that any big retailer is profiting in this scenario is clearly bonkers. Tesco's profit margins are only about 4%, and they've been pretty consistent around about 4% for a great number of years. So there's no evidence here of profiteering. It's simply one company doing a little bit better, and the numbers being flattered by a bit of a pickup in economic activity as well.
Yeah, I think Tesco explained that part of the reason why is because they're making stronger profits on higher margin, higher end products. So the Tesco Finest range is doing quite well because people, rather than going out and going to a restaurant to spend their money, they're staying in and having a slightly more luxurious evening. Yeah. Now, obviously, that's terrible for the hospitality sector, but good for Tesco and it can in itself explain part of the reason why. You also see the fact that because they are kind of at the mid to lower end of the supermarkets, that they've also just picked up some market share. People who might have previously gone to more expensive supermarkets have gone down to Tesco as a result of pressures.
Now, on top of that, another thing that frustrates me is that people don't really understand numbers. So they see a figure like 2.3 billion and think, oh gosh, that's an absolutely enormous number. Now, of course, for most companies it is, but not for a company the size of Tesco's. It's by far the UK's biggest single retailer. Its turnover, you can measure it different ways, but it's something close to 70 billion. So profits of 2.3 billion on turnover close to 70 billion is actually quite unremarkable.
Yeah, it almost made me think, I saw someone saying online that, well, I feel like this is great as a Tesco investor. And I'm like, do you really want to be a Tesco investor? Is that the company you want to put your money in? It doesn't seem like they're a particularly high margin entity. I mean, the average profit margin is probably something closer to 10% than it is to 4 or 5%. So I'd be happy as a supermarket for what Tesco is achieving, but I don't think I'd be happy as an investor when I had other options.
I mean, to be fair to Tesco's on another point, I mean, they have actually been increasing the wages of their workers at quite a decent clip. I mean, they've had to, of course, because there are labour shortages, but the workers, people who work at Tesco's are benefiting from the success of the business as well as the shareholders, but also, of course, the customers. That's the whole point. I mean, the reason why Tesco is successful is that it is such a major retailer that provides loads of goods and also some services at relatively affordable prices. So this is sort of market led. People aren't forced to shop at Tesco's, but lots of them decide to do so.
There's a sense in which, though, Tesco and perhaps other supermarkets as well have been allowed or emboldened by the cost of living crisis to put up their prices, that the farmers will complain, although I don't know if this is entirely true. I'll say we're not seeing the big benefits that you see in retail prices going up, but the supermarket teams were benefited anyway. And then the people perceive the price rises they see as the fault of the retailer, and then they see this profit margin, they get really angry at it. I'm wondering what you say to that.
Well, again, it's not clear to me what they are supposed to be angry about, because the profit margins are very small, as I said, about 4%. So if they're just looking at the headline numbers, then you need to put those in context. And as I say, those numbers are unremarkable for a company the size of Tesco's. If they were profiteering, then you'd expect those numbers to be at least twice as high as they actually are.
They'd be very poor at profiteering. I mean, the other point as well that's often missed is the sense that, Tesco is monopolizing or some kind of oligopoly. But there's so much competition in the sector. I mean, I compare it to people complain about, in Australia, a supermarket duopoly, because Coles and Woolworths, between the two of them in the Australian context, have something like 80% market share, which you could argue is quite substantial. Maybe they do have some market power. But applying that to the UK just seems ridiculous. I mean, Tesco is the biggest at 25%. And then from there, the next biggest is like 10, 15% at Sainsbury's and Aldi. And then you have so many other smaller stores. You have corner shops, and you have the likes of Amazon also coming into the sector.
Well, the game changer for me is the ease of comparing prices between supermarkets. I mean, you've always been possible to do that, but it's so much easier now with the internet. So you can easily go online to find out whose prices are cheapest. On top of that, of course, you have the supermarkets themselves matching prices against each other. So in that environment, unless you can show any evidence at all of some sort of cartel cooperation going on behind the scenes, and there's no sign of that given how tight the profit margins are, then there seems to be an industry where complaining about profiteering is just dust.
I suppose there's a broader sense here in which profit is seen as something dirty, that it's kind of immoral for a company that is providing such an essential service would dare make a profit in the process, that profit is immoral. I'm wondering what you make of that kind of argument, that, okay, you might be right, the profit margins are slim, but the profit margin's gone up, and any profit is too much.
Yeah, no, I do understand the optics of that. So when something is in short supply and therefore the price of that good or service rises, then people may well feel that the provider of that good or service is taking advantage of that. And I do understand that at a human level. But as a piece of economics, it's pretty poor, because it's precisely that increase in price and the profit associated with it that you need to correct the imbalance between supply and demand that's caused the problem in the first place. So on the one hand, the fact that companies can sell their good or service at a higher price encourages them to produce more of it. But also it makes sure that those people who perhaps don't need that good or service as much as other people do decide to spend their money on something else instead. So the pricing mechanism is absolutely essential to balance supply and demand. And interfering with that pricing mechanism is a really bad idea. Now, it might be that you're worried about the impact of shortages on particular types of people, but the correct solution there is to subsidise their incomes rather than intervene and control prices. So you might top up the income of those who have smaller budgets to make sure they can continue to afford goods and services that are more expensive. But what you don't do is artificially manipulate prices downwards, because that discourages the right price responses, both on the supply side and the demand side.
Well, I mean, classically, price controls lead to, and there were some demands for them early on in the cost of living crisis. I mean, they do inevitably lead to shortages, because if you have to sell a good at below the cost of procuring that good, then you simply stop selling it. I mean,
and there's so many examples from the last few years. Just to give two, one is that there's some people suggesting that energy prices shouldn't have been allowed to rise at all during the fallout from Russia's full-scale invasion of Ukraine, that we should have kept prices very, very low, which would have been very damaging, because that wouldn't have encouraged people to save on energy where they can, and it wouldn't have provided the incentive for companies to provide more energy into the market. Another classic example, of course, is rent controls, which is a classic example of a bad idea that never ever seems to go away. And as far as I'm aware, every single example of rent controls has backfired in one way or another, including the recent experiments in Scotland, where the Scottish government has intervened to cap rents. It's backfired in terms of reducing the supply and quality of housing available, but also in some cases actually prompted landlords to raise rents by more than they otherwise have done, while they still can before the end of before a tenancy has to be renewed.
Yeah, and the Scottish system also had something about how you can't change the rental costs within the rental agreement, but you can change it between rental agreements, and actually you're just going to charge more to begin with.
Exactly.
For the risk of not being able to.
So landlords front load any increase in rent they might be thinking of doing to make sure that they can still make a decent profit.
They're not restricted from doing it. I mean, I think there's also the other important element here, which is profit is the reward for being able to provide a service or a product. It's the reward for the totality of what you're selling being better and more valuable to the consumer than the sum of its parts. I don't think that's particularly understood. It's what encourages the Tesco to exist. I mean, Tesco will say nice things about why they're cutting prices or how they're supporting food banks, but Tesco is a company and its purpose is to deliver a profit. And the reason why people invest in Tesco or put money into Tesco, perhaps not the best investment, as we said, but the reason why people are willing to put their capital into it and to build supermarkets and to create complex logistics systems and to find supply chains from around the world to deliver products and get them, to you at the right time in the right place. Quite an extraordinary achievement in itself, what Tesco is doing or what any supermarket is doing. But in order to motivate doing all that work, you have to have some level of return.
Yeah, and also it's not just about profits; it's about the dividends that those profits fund, in effect. And there's been a lot of fuss recently about companies continuing to pay dividends during the cost of living crisis. But the point is that the dividends are the return that investors expect for committing their capital to a company. So if you buy stocks and shares in a company, or if you lend money to it in one way or another, then you expect some sort of return on that money, or else why are you doing it? These businesses are not charities. They need to make a return in order to continue to attract capital to invest in the company, to pay workers' salaries and so on and so on.
Yeah, I suppose the unstated alternative to not making a profit is the company ceases to operate. And do you really want a world where Tesco doesn't exist, or where supermarkets don't exist? And there's also the interesting point you were making there about kind of what price signals do. So in practice, if Tesco can one year make a high profit or the prices go up in the store, then there's an incentive for people to enter the market to compete with Tesco and to supply the goods and to push down that profit if it is excessive.
Or indeed the likes of Aldi or Lidl can look at Tesco's and say, right, what are they now doing that we need to catch up with? So even it doesn't necessarily have to be new entrants. It's the constant competition between the existing companies to try and get those numbers up. And that's also where, of course, the financial markets play a key role, because people can switch investment between one supermarket and another. And if one company delivers good results, then that attracts more investment into that company, boosts its share price, and that creates a virtuous circle.
Yeah, and the reverse of that is, Waitrose has come under John Lewis. Waitrose has come under a lot of slack in recent years because they haven't been performing as well, and they've had issues with their IT systems and logistics. I mean, that will then push people to the alternatives. It's not like there isn't M&S or Ocado or Amazon or whatever else that consumers can go for. I suppose that this also links back to the other point, and you say companies are not charities. These days we hear a lot about this idea of stakeholder capitalism, which, to summarize, is this notion that the primary and only purpose of companies should not be to deliver profit to shareholders. While that's important, companies should also think about other things like the rights of their workers, the environment, the local community, perhaps diversity and inclusion requirements as well in there. I suppose it's that different vision of why companies exist that almost come to conflict here.
Well, I tend to take the sort of Milton Friedman view on this. I mean, he was very clear that almost said the sole purpose of a company is to make profit. But even he caveated it a little bit by saying within the rules of the game. So I certainly don't think that a company should make large profits by exploiting its workers or damaging the environment. And I'd hope also that there are mechanisms in place to prevent that from happening. So, for example, if a company does damage the environment, it should be whacked with an enormous fine to discourage it from doing so again, and making sure that the shareholders don't reward that behaviour by paying staff more. So there are limits, but at the end of the day, I think it should be left to individual companies and the people that own them, the shareholders and other stakeholders, to decide how the company is run. Now, that may well mean that you want to run a company on a fairly charitable basis. I mean, you mentioned, John Lewis. John Lewis is a partnership effectively owned by the people that work there, and there are other examples as well. Perfectly happy with that business model. If that's how the stakeholders want to run the business, then that's fine. At the end of the day, companies are simply ways of people coming together to to minimise transactions costs and to make sure that their efforts are pooled together in a more efficient way. But the precise model, I think, should be left to the individuals to decide. And some models may be more successful than others, but I don't think it should be for the government to say that this sort of model is better than another.
I suppose that there's a bit of a principal agent problem here. There's a bit of a risk, and I think Milton Friedman does discuss this as well, where although the shareholders might have one preference, the executives and the managers might have a different preference. In fact, Adam Smith talked about this issue when it came to limited stock companies. It's not a new problem. It's as an investor into a company, particularly when you're a relatively small scale investor, you have very little say or control over the operations of the company, and the executive are not necessarily that well held to account.
That's true. I mean, there are certainly whole swathes of sort of managerial theories of the firm, how bosses like to sort of aggrandize themselves. They go out and do big acquisitions and so on because it gives them a good headline.
Or they go and say trendy political things in order to boost their standing at the local golf club. Or something.
So inevitably there are problems there. But I think it's a danger that what a lot of people do is they compare the sort of the reality of capitalism and a market economy with some sort of ideal version of the alternative. Some sort of ideal version of socialism where everybody behaves brilliantly, there are no government failures and so on and so on. I think in practice, if you look at real world capitalism, compare it to any of the real world alternatives, real world socialism, capitalism wins out every time.
So moving on from our chat about Tesco and profits, there's been some other interesting news this week on the macroeconomic front. We've had ONS statistics about employment and inflation. Perhaps the biggest news is that the CPI rose by 3.2% in March, which is down from 3.4% the month before, although still above the bank's target. I'm wondering, what does this mean? Most often, people asking the question, what does that mean for interest rates?
Yeah, well, we're taking the inflation numbers first, and there was a little bit of disappointment. People were hoping from a fall from 3.4 to 3.1. In the event, it was only a fall to 3.2. And I'm realistic. The difference between 3.2 and 3.1 is a rounding error in the numbers. What is important is the trend, and that is clearly down. And in particular, there's going to be a sharp fall in inflation in the April data, which is when the reduction in the Ofgem cap on domestic energy bills kicks in. So headline inflation in April is almost certainly going to be below 2%, which is therefore below the Bank of England's target. And I think it'll make it much easier for the Bank of England to cut interest rates, most likely in June, once it's got those numbers. There are still a few things that are making some people at the Bank of England nervous. And that's essentially, if you look beyond the headline numbers, at the strength of services inflation. So that was still running at about 6% in the March data. And a lot of that is due to the what's happening in the labour market. So services often depend most on what's happening to wage costs. And those are still rising at about 6% on the headline measure as well. So there are probably some people at the Bank of England who'd still want to see further evidence of a cooling in the labour market. But we are seeing that. So if you look at employment, that's down, vacancies are down, unemployment is now up. And if you look at the latest evidence from recruitment agencies, they say that recruitment is slowing sharply and that starting salary increases are coming down as well. So I think if you look at the forward-looking indicators, then I think wage growth will drop off over the next few months. And again, more signs of that should be enough for the Bank of England to cut rates.
Yeah, the employment stats, which were also out this week, had almost like a mixed signal there, which is, on the one hand, it did appear that wages are going up faster than inflation. I guess people would say that's good news, although if that's just baking in inflation down the track, that's not such good news, unless there's some kind of associated productivity improvement that kind of justify the wage increase. But on the other hand, though, it does seem like there's a slight weakening, a very slight weakening in things like employment and vacancies.
I'm relatively relaxed about what's happening to wages in terms of the impact on inflation. I think it's actually right that wages should be rising faster than prices at the moment. So we should be having real terms increases in pay because there are labour shortages. And one of the ways you correct a shortage of anything, whether it's labour or anything else, is that the price of that good or service rises. So I'm quite relaxed about the idea that real pay should be increasing. It's a slightly different view from the Bank of England. The Bank of England is obsessed with the idea of a wage price spiral, but actually all the evidence at the moment is that wages are simply sort of catching up a bit with prices. They're not leading prices. So that's not something you should be worried about. So if we do get a period where real wages continuing to rise, but maybe the prices of other goods and services maybe even falling outright, as some of them now are, the inflation print for quite a few parts of the economy is actually negative in March. So things like household goods, transport, and so on, those prints are actually negative. So you can get a mixed picture where some things do rise more than others, but that's just the pricing mechanism at work. You can't have everything just moving at 2%.
It does seem though the broader story is one of not particularly a lot of economic excitement, I suppose, in either direction. We're not seeing big falls in economic growth or employment, or inflation's kind of leveling off, but all we're seeing the kind of growth we might want to see, especially since we've had such a long period of stagnation.
Well, that's a good point. I think as far as sort of business and consumer confidence is concerned, it's more sort of the direction of travel rather than specific numbers that matter. And I think there is a sense now that the economy has turned the corner, that things are recovering. It does look likely that the economy grew by at least 0.4%, maybe 0.5% in the first quarter of the year. Now that's not a great number given the weakness that had gone before, but it does mean we can stop talking about the economy being in technical recession. And similarly, we're a month or two away from inflation falling below the Bank of England's 2% target. And that will be followed by interest rate cuts, not necessarily massive interest rate cuts, but they clearly are pivoting away from the period of relatively high interest rates that we've had over the last couple of years, which has undoubtedly squeezed growth. So it's about the direction of travel. If you step back a bit, though, and look at the longer term picture, then the economy has been sluggish since the global financial crisis of 2008, 2009, particularly poor performance on productivity. So the big underlying problems. But in terms of where we are in the economic cycle, the next sort of 6 to 12 months, I think, will look a lot better than the last couple of years.
The IMF, though, also had a report out this week where I think it was predicting the UK is pretty middling. I think it was something like 0.5% growth this year, 1.5% growth next year. More or less average by European standards, if I've quoted that correctly. I'm wondering what you make of those predictions. Are those the kind of things that we shouldn't take too seriously?
I wouldn't take the IMF's economic forecasts too seriously. That's not really their strength. They are quite good, though, at the underlying economic analysis. And if you look beyond the headlines, that's some quite interesting stuff in the latest World Economic Outlook about the scope, for example, for productivity to benefit from improvements in artificial intelligence. They actually singled out the UK as an economy that might benefit more than most there. It's also worth noting that this week the IMF has released what they call a fiscal monitor, which is a sort of health check on the public finances in the major economies. And as it happens, they had a bit of a dig at the UK, criticising the cuts in national insurance and warning that they might undermine the longer term progress towards getting the public finances back into good shape. But the bigger thing for me is to have an even bigger go at the United States, where there's been this massive fiscal expansion, tax cuts, spending increases over the last few years that I think whoever wins the elections in November will probably continue. And that's, I think, probably the biggest single concern the IMF has is what's happened to fiscal policy in the US, which have all sorts of knock-on effects to the rest of the world. If, for example, it means that US interest rates are higher for longer than they would otherwise have been, or if it means that other countries have to offer higher interest rates on their own government debt in order to compete with US Treasury bonds, their equivalent of government bonds, that could be a problem as well.
Well, Julian Jessop, IEA Economics Fellow, thanks so much for joining the IEA podcast. If you are enjoying the IEA podcast, please do subscribe on your chosen podcast provider. And if you'd like to learn more about the IEA's work, just visit iea.org.uk.